Our next speaker is Ladislas Paszkiewicz from Total. Total is a broad energy company that produces and markets fuels, natural gas and electricity. With over 100,000 employees and active in more than 130 countries, the company is committed to better energy that is more affordable, more reliable, cleaner and accessible to as many people as possible. Ladislas Paszkiewicz has worked at Total for 35 years. He was Senior Vice President, Strategy and Climate before being appointed Senior Vice President, Investor Relations of Total in 2019. Ladislas, over to you.
Thank you, James, and thank you very much for giving me the opportunity to discuss in more details Total and Total strategy, totally changing fast. So I'm delighted to be here with you and share this. The basis of what I'm going to present to you about the strategy of the company relies on two major trends, which are the following. On the one hand, the population is growing in emerging countries and aims at higher living standards, which means that demand for energy in the future is going to increase. At the same time, there is the objective that we all know about climate neutrality. And so the answer, or the way Total is positioning itself, is that we have at the same time to combine the two together by growing energy production while stating the ambition that you can see here on that slide of getting to net zero together with society by 2050. And this is regarding all our production and energy products that are used to our customers. So what does that mean more specifically? That means that for emissions of our operated oil and gas facilities, yes, we want to get to net zero emission by 2050 or sooner. But this is not only for our own emissions from our facilities. We also have some ambition with regard to emissions from products which are sold to our customers. And for those ones in regions that did commit to net zero, like Europe, for instance, we do commit to get to net zero emissions for those products used by our customers by 2050 in Europe in particular. And we wish actually to do that on a global basis, would of course country decide or regions decide to do the same. So how do we get there? We get there by transforming Total into a broad energy company. And the way we've presented it is through these four different levers, where you see for natural gas, we consider it will play a major role in the transition, as gas is available, it's affordable, it has environmental benefits as it emits half as much as CO2 compared to coal for power generation. And it's a very good complement to renewable because it manages actually the intermittency that is associated with renewable. And gas can become greener. You can blend it with renewable gas or with hydrogen. So making it greener is also one of the areas that we're going to study more in the future. So that's natural gas. Then electricity. Electricity is by no doubt the energy of the 21st century. And so we will accelerate investments in that regard, being integrated along the electricity chain. And I will come back more in detail on that aspect, which is critical for the development of Total in the future. Oil. Oil demand may plateau at some point in time, maybe 2030 plus. And in that long-term framework, we need to focus on low-cost oil, as if and when oil demand is going to decrease. Of course, if demand decreases, it may be the case also have some impact long-term on price. And so for us, what is critical is to focus on low break-even, low-cost oil and develop biofuels. And finally, carbon sinks. It's very important to keep in mind that in any scenario of the energy transitions, the world will continue emitting CO2. So if we want to get to net zero, we'll have to find solutions that permit having negative emissions in order to get to net zero. And that is exactly what Total is engaging on, both with NBS, natural-based solution, and CCS, carbon capture, usage and storage. So that's the way Total will become Total Energies, creating value for shareholders. So I mentioned that we want to grow energy production. You can see here on that slide that we are currently producing about 3 million barrels of oil equivalent per day under different forms of energy. This is going to increase to about 4 million barrels of oil equivalent per day by 2030, so +1. And this +1 will be made half of LNG, liquefied natural gas, and half of electrons. So you see that the growth of the company is going to be driven by electricity and by gas. At the same time, in 2030, Total will be a very different company from what it is today. You can see on the left-hand side of that screen the energy mix of the sales to our customers. And you see that in 2019, well, we sold more than 50%, actually 55% of the energy sales were oil products. And 40% was gas and 5% was electrons. This is going to radically evolve over the next decade, as by 2030, we'll sell only 35% of oil products and 5% of biofuels, about 50% of natural gas, and 15% of electron and renewable gas. So this is a completely different picture. As you can imagine, actually, you need to invest and change, actually, this significantly. I will come back to that. But what that means in terms of emissions is that emissions of our customers associated with this new portfolio that I just described are going to decrease. In absolute term, what we call scope 3 emission, which means emissions of the products that we sell to our customers, are going to reduce between 15 and 2030. And specifically in Europe, they will go down by 30% over this period. This is a strong commitment that Total is taking. I don't know about any company having disclosed or mentioned some targets in absolute term for reducing these scope 3 emissions. So that's really to show you that we are very much engaged on this energy transition process at Total. Let me now focus a little bit more on power and e-mobility. Power, as I mentioned to you, along with gas, will be actually the main driver for growth of Total in the future. In renewable and electricity, to develop sustainably, we need at the same time to have profitable projects and to manage risk by being integrated. And this is what is illustrated on that slide, where you see that by 2025 will produce about 50 terawatt-hour of electricity, mainly from renewable, but then we'll trade that, we'll store it through grid balancing, so have the ability actually to manage this intermittency and sell it to final customers that we have as a target actually to have 9 million customers, and we'll sell to them about 80 terawatt-hour. So you see that there is an integration along the chain, which by the way is similar to the one that we develop in the gas business, where you will manage our risks in a better manner, as it is always the case when you get integrated. So you see here, 50 terawatt hours by 2025, which is quite a large figure. If you project until 2030, the increase is going to be even more dramatic, as we intend to sell about, to produce and sell, but to produce 120 terawatt hour by 2030, which means that every single year, on average, between 25 and 30, will add up about 10 gigawatt of growth capacity. This is a strong increase, a strong commitment. This will come from wind and solar, and in particular solar. But I would like here maybe just to zoom, just to focus 1 second with you on offshore wind, as it turns out that we're going to develop and to develop further in this area. We have very recently announced a deal called on the Sea Green project with SSE in Scotland, offshore Scotland, 1.5 gigawatt. That's a very large project. But interestingly enough, we are also developing in floating offshore wind with projects that we have in offshore Wales with this Erebus project, and also in South Korea with a very large 2 gigawatt or more than 2 gigawatt project. We do believe that the potential offered by floating offshore wind is very significant, maybe 10 times more than what can be offered on fixed bottom offshore wind. And you can imagine that a company like Total, having a lot of expertise in offshore activities through our exploration and production business, is very well positioned to develop successfully with different competitive advantage, as of course the ability to run large-scale project, expertise in offshore, trading expertise, large-scale projects that were used actually to develop. So that will be one of the drivers for future growth in the renewable business for Total. All of that needs also to be sustainable on a financial point of view, and we strongly believe that ecology goes together with economy. So we need actually to develop profitability, and we have defined in renewables activity a hurdle rate where we want to have on the projects that we launch or that we develop a 10% or more IRR on equity. That's very important because, of course, we need to combine volume with profitability. This is absolutely mandatory if we want to be successful. And you see here that the targets we are defining are that by 2025, we should get a net operating income of about $1 billion with cash flow from operation, which is really at the heart. It's the metric that we use the most in terms of financials, with a CFFO of more than $1.5 billion by 2025 in order to ensure sustainability of the development of that business. Now, a short one on electric mobility. or mobility, which is, of course, a key subject for the years to come, and will commit about $1 billion in the next 10 years, actually, in this electric mobility value chain through investing in battery manufacturing. And we have a large project with the automaker Peugeot in Europe, where we'll leverage from the R&D from the group, in particular through the Saft company, which is a battery company that Total we bought in 2016. So developing actually large projects, gigafactories, benefiting from subsidies in that regard, and with the objective to get more than 10% equity IRR. So that's on one side. On the other side, we'll develop the EV charging segment. We have currently about 10,000 operated charging points, and I'm very proud to say that this is developing quite rapidly. We recently announced that we had acquired some EV charging points in London after Amsterdam. I mean, Amsterdam came first, and Brussels, and very recently, actually, we won also the call for tender for Paris. So we will develop in this EV charging segment with a target of 150,000 charging points by 2025. So you see it's an increase by tenfold, which is not insignificant, it is, and with the same objective in terms of return on investment. In mobility, I should also point out that it is not just electric mobility, but we develop also in renewable diesel, which is an attractive market, fast growing. It's growing at more than 10% per year. So it's for us a very interesting market that we're going to develop significantly in, where the benefit, the advantage of this renewable diesel market is that there is no limit of incorporation in gasoline or diesel, because products are hydrogenated, and so they can be blended with no limit, which is, of course, a huge advantage. And they are also certified for aviation fuel. So this is a segment of the biofuels market where we'll develop with the aim by 2025 to produce between 2 and 3 million tons, to the benefit, of course, of the company. And in terms of feedstock, for those renewable diesel, will privilege waste and residue as used cooked oil or animal fat. So you see that we are very much engaged in electric mobility, also in mobility through renewable diesel business. All right, so where does all of that bring us to? In terms of financials, of course, we need to invest money in these businesses in order to grow renewable and electricity. And as you can see here on that slide, the share of the capex that we are dedicating to this renewable and electricity is going to increase significantly over time. It's today about 10% with 1.5 billion. It was in between the last 5 years. In the 5 years to come, it will be more than $2 billion that we will dedicate to this renewable and electricity business, representing more than 15%. And in the second half of this decade, it will be more than 3 billion, or more than 20%. So you see how we are dedicated actually to realize, to implement this strong development towards renewable and electricity, as we will dedicate more and more of our capex in this business. The result of that would be in a $50, $60 environment that you can see here on the right-hand side, what it would be, and it would be an increase in cash flow that will be quite significant, as you can see, in a similar environment, reaping the benefit actually of such growth, the growth from renewable, growth from LNG, growth also from the downstream that will contribute actually additional cash flow to the business between now and 2025, with return on equity more than 10% at $50 per barrel. Finally, in terms of cash allocation, the priority of the company remains capital investment. We want to grow, as I mentioned at the beginning, that to supply actually increasing energy demand, we need to develop, and we want to develop the company with 13 to 16 billion being invested per year between 22 and 25, with this focus on renewable and power, as I mentioned, of more than 2 billion. Dividend is supported at $40 per barrel, which is something extremely important for us, and vis-a-vis our shareholders, loyalty to shareholders is something we pay a lot of attention to. Balance sheet is definitely a name of the game, meaning we want to maintain a gearing below 20%. It's critical actually to keep financial muscles, because we know about the volatility of those markets and we've experienced them. And then potential share buybacks in case we would have gearing below 20%. Dividend has increased, as you can see, in the past very significantly, and today it is supported at $40 per barrel, offering a good yield. Finally, to conclude this presentation, I should say that yes, we are transforming the company and growing profitably, while at the same time decreasing emissions. So we'll grow from LNG and renewables. We are committed to reduce Scope 3 emission by 2030, as I explained, and thanks to low break-even and robust balance sheet, we support the dividend. So we believe that this is a compelling investment case. We know that the multiples that the market is paying for in renewables are quite high, actually, and so we are developing this part of the business. At the same time, we have very strong fundamentals with strong balance sheet and low break-even that permits us actually to grow and to supply, or to answer actually to an increasing supply, what we do believe should support a re-rating of the stock. So this is the extent of what I wanted to share with you. And I think now I turn back to James in case there would be some questions.
Thanks for the presentation, Ladislas. I think it really does underscore the scale and the scope of the transformation that's underway in the energy sector, and particularly at Total right now. My first question, it's no surprise to anyone that many investors in the sector invest for income. And the pandemic's seen, many of your peers cut their dividends. What drove the decision at the time to hold on to your dividend payment, and what reassurance can you provide investors regarding the dividend policy going forward?
Well, you're right to mention that back in Q1 or beginning of Q2, when the oil price actually dropped below $30 per barrel, well below, the board reviewed the shareholder return, and given, I think, the strong fundamentals of Total, the low break-even, the low gearing, it decided to stay cautious and not to overreact, and so the dividend was maintained. And today, of course, management is looking at it very closely and mentioned, and I just repeat this statement, that the dividend is supported at $40 per barrel, which is slightly below the current price that we have. So that's what really I can say on the dividend policy.
And given that low oil prices have seen capex budgets slashed across the board recently, many commentators believe this is ultimately going to lead to big price increases across the commodity space, especially if we get a strong recovery from the pandemic. To what extent do you buy into that narrative?
Well, first, I would say that our job is not to bet on the evolution of the oil price. It's very difficult, and we consider our responsibility as price takers actually is to do anything that is under our control actually to be resilient and to make sure that we are cost effective and resilient in case of the oil price to be low, while benefiting, of course, and reaping the benefit in case it would go high. But so our responsibility is really to focus on delivery, on cost, on cash. That's really very important. Now, you're right that even if in the short term we are with a lot of uncertainty, we do tend to observe that there has been a lack of investment in the past years, with few FIDs, final investment decisions, having been taken, and at the same time we experience a natural decline of 4 to 5% in the oil markets, and quite some uncertainty in the oil shales out of the US. So this combined together should lead to reduced supply at some point in time in the years to come. You're right. Now, on demand, it's very difficult to assess, but this reduced supply is, in our view, supportive for oil price rebound in the medium term. So we'll see where it goes to, but I think it is reasonable to assume that given this analysis, yes, we could have some rebound in the price in the middle term.
Ladislas, thank you very much for that. And don't forget, everybody, that you can read more about Total at Total's exhibition booth. So do go over there and check that one out. Thanks very much.
Thank you, James.
Thank you.